Turning 65 doesn't just change your birthday candles. It quietly changes your legal relationship with a whole list of bills, taxes, and government programs. None of it activates on its own. No agency sends a letter saying, "Hey, you qualify now." The forms just sit there, waiting for someone to ask. Here's the thing. This list isn't just for people stretching a fixed income, and it isn't just for people with a paid-off house and a stock portfolio either. There's something here for both. Stick around, because by the end, you'll have a full list of programs, forms, and thresholds worth checking against your own situation. Verified, current for 2026, and explained in plain English. Let's start with property taxes, because this is where the biggest, most overlooked savings tend to live, especially for anyone who's owned a home for a long time. In most states, there isn't just one senior property tax break. There are typically up to 3 separate layers, and each one requires its own paperwork with the county. Layer 1 is the general homestead exemption, available to homeowners of any age in many states, which reduces the taxable value of your primary residence before your bill is even calculated. Layer 2 is an age-based senior exemption, stacked on top of the homestead exemption, in a number of states, including Texas, Florida, Georgia, and Tennessee. This exemption is based on age alone, with no income test attached. That surprises a lot of people who assume senior exemption automatically means income restricted. Layer 3, where it's offered, is an assessed value freeze. Once you're on file as 65 or older, the county locks in your home's taxable value, or in some states, the tax amount itself at that point going forward, even if your neighborhood's home values keep climbing. Exact dollar amounts, income limits, and whether all 3 layers even exist vary significantly from state to state and county to county, so specific figures aren't something we'll quote here as universal. They're worth confirming directly with your local county assessor's office by name. Ask about the homestead exemption, the senior exemption, and any assessment or tax freeze, and what the filing deadline is. And if you rent instead of own, this still touches you indirectly, since property tax costs typically get built into rent pricing over time. Now to the IRS side of things, and there's a genuinely new piece here worth knowing about. For the 2026 tax year, the standard deduction is $16,100 for single filers and $32,200 for married couples filing jointly, per IRS Revenue Procedure 202532. On top of that base amount, taxpayers who are 65 or older already got an additional standard deduction before this year. For 2026, that's an extra $2,050 for a single filer, or $1,650 per qualifying spouse for a married couple. What's new starting with the One Big Beautiful Bill Act is a third layer, some people are calling the senior bonus deduction. An additional deduction of up to $6,000 per qualifying person aged 65 or older on top of both of the amounts above. For a married couple where both spouses are 65 plus, that can mean a combined standard deduction in the neighborhood of $47,500 before anything else on the return is factored in. A few important details on this one. It phases out gradually above $75,000 of modified adjusted gross income for single filers, or $150,000 for married couples filing jointly, and is fully phased out above $175,000 single, $250,000 married. It's temporary under current law, written into the tax code for tax years 2025 through 2028 only, not a permanent fixture. Whoever prepares your return needs accurate birth date information on file, since that's what triggers eligibility for both the age-based deduction and this newer bonus deduction. This is general information about how the deduction is structured, not a recommendation about your specific return. Confirming what applies to you is a conversation for a tax preparer or the IRS's own guidance, not this video. A separate question from your standard deduction is whether your Social Security benefit itself gets taxed. The IRS uses something called provisional income, roughly your other income plus half your Social Security benefit, to determine this. If that combined number is under $25,000 for a single filer or $32,000 for a married couple filing jointly, none of your Social Security benefit is federally taxable. Above those thresholds, up to 50%, and at higher income levels up to 85%, of the benefit can become taxable, though at least 15% of your Social Security benefit is never subject to federal tax, regardless of income. Those $25,000 and $32,000 thresholds, unlike a lot of other tax figures, are not adjusted for inflation. They've stayed the same for decades under current law. On top of the federal question, most states don't tax Social Security benefits at all as of 2026. A small handful of states still apply some tax to it, often with their own exemptions layered on for lower and middle incomes, so checking your specific state's rules is worth doing rather than assuming either way. One more piece worth knowing about. There's a form, the W-4V, that lets you request voluntary federal withholding directly from your Social Security check. Some people set this up when they first file and never revisit it. Whether that withholding percentage still matches your actual tax situation years later is something to review with a preparer, not something to leave on autopilot indefinitely. Medicare Part B has a real, standard monthly premium, and for 2026, that amount is $202.90 per person, automatically deducted from Social Security for most beneficiaries, an increase from $185.00 in 2025. What a lot of people don't realize is that Medicare Savings Programs exist at the state level, and if your income falls within the limit, the state pays your Part B premium for you going forward. There are three main tiers. QMB Qualified Medicare Beneficiary, the most comprehensive tier, covering the Part B premium plus most deductibles and coinsurance. For 2026, the federal monthly income guideline is around $1,350 for an individual or $1,824 for a couple. SLMB Specified Low-Income Medicare Beneficiary covers the Part B premium only, with an income guideline around $1,616 individual, $2,184 couple. QI Qualifying Individual also covers just the Part B premium, with a guideline around $1,816 individual, $2,455 couple, and is funded on a capped, first-come basis each year. Federal resource limits sit around $9,950 for an individual and $14,910 for a couple, though a number of states either use higher limits or don't count assets at all. California is a notable example with much higher limits. These are federal baseline figures. Several states run their own, more generous versions, so checking with your own state's Medicaid office or a local state health insurance assistance program SHIP office is the way to get an accurate answer for where you live. Enrollment in one of these Medicare savings programs often also connects you to Extra Help, a separate program that lowers Part D prescription drug costs, premiums, deductibles, and copays. A separate note, unrelated to income, Medicare Part A, hospital coverage, is premium-free for most people who, or whose spouse, worked and paid Medicare taxes for at least 10 years. That's not income-based at all. It's a work history question. And for people with higher incomes, there's a separate add-on called IRMA, an income-related monthly adjustment that increases Part B and Part D premiums. It's calculated using tax return information from 2 years prior, not your current income. If your income has dropped since then due to something the Social Security Administration classifies as a life-changing event, retirement, loss of a spouse, divorce, or a significant income reduction, a form called SSA 44 exists specifically to have that surcharge recalculated using more current numbers. Two federal programs worth knowing about, even though the dollar amounts are smaller individually. Lifeline is a federal program that can reduce a phone or internet bill by up to $9.25 a month for eligible low-income households, or up to $34.25 a month for households on qualifying tribal lands, with some states layering additional discounts on top. LIHEAP, the Low-Income Home Energy Assistance Program, helps eligible households cover heating and cooling costs directly, with the amount varying by state and situation. Eligibility for one of these often overlaps with eligibility for the other, and both are applied for separately. Lifeline through the National Verifier System, LIHEAP through your state's program office. The next few items apply specifically to people who've built up equity in a home, or savings in retirement and investment accounts. Background information, not a recommendation about what to do with any of it. Selling a primary home. Under current federal law, if you've lived in a home as your primary residence for at least 2 of the last 5 years, up to $250,000 of the gain on sale can be excluded from federal tax for a single filer, or up to $500,000 for a married couple filing jointly. Gain here means sale price minus what was originally paid minus qualifying improvements, not the full sale price itself. The 0% long-term capital gains bracket. For 2026, a single filer with taxable income up to $49,450 or a married couple filing jointly up to $98,900 falls into the 0% bracket for long-term capital gains under current IRS figures. Taxable income here is after deductions, including the standard deduction and any age-based add-ons discussed earlier. So gross income can run meaningfully higher than these thresholds, and someone could still land inside this bracket. Whether or when this applies to any specific person's situation depends on their full tax picture and is a conversation for a tax professional. Roth conversions. This is a mechanism, not advice. Converting money from a traditional IRA or old 401k into a Roth IRA means paying ordinary income tax on the converted amount now, in exchange for tax-free growth and no required withdrawals from that money later. Whether, when, or how much to convert depends entirely on an individual's full financial and tax picture and is a decision for a licensed financial or tax professional. Not something a video can responsibly tell you to do. Required minimum distributions RMDs. Under the SECR 2.0 Act, the age at which the IRS requires you to start withdrawing from traditional IRAs and old 401ks currently sits at 73, rising to 75 for younger cohorts under the law's phase schedule. These forced withdrawals count as ordinary income, which can affect how much of your Social Security is taxable and can factor into the IRMAA calculation described earlier. Qualified Charitable Distributions QCDs. For people 70 and a half or older, current law allows funds to be transferred directly from a traditional IRA to a qualified charity, up to $111,000 per individual for 2026, without that amount counting as taxable income, and it can count towards satisfying an RMD. The transfer has to go directly from the IRA custodian to the charity to qualify. Survivor benefits. If you're widowed and your spouse worked and paid into Social Security, you may be eligible for a survivor benefit based on their earnings record, potentially starting as early as age 60. The Social Security Administration will process whichever benefit you formally apply for, but determining which sequencing produces a better outcome for your specific record is something the agency doesn't proactively walk you through. That comparison is worth doing directly with them or with a financial professional before filing. Free tax preparation for people with fairly straightforward returns. Social Security, a pension, maybe an IRA withdrawal. There's an IRS-affiliated program called Tax Counseling for the Elderly TCE for people 60 and older, staffed by IRS-certified volunteers. The largest provider network is AARP TaxAid, and AARP membership isn't required to use it. More complex situations, business income, rental property, a complicated estate, are generally better suited to a paid professional. The widow's Medicare premium gap. Here's how this one works. IRMAA, the income-related Medicare surcharge mentioned earlier, is calculated off a tax return from 2 years prior, including the filing status on that return. If a couple filed jointly, their combined income was measured against the married IRMAA thresholds, which are roughly double the single thresholds. In the year after a spouse passes away, the surviving spouse's filing status shifts to single, but Medicare's system may still be working off a joint return from before the loss. That mismatch can put a surviving spouse's premium into a higher surcharge bracket than their new individual income would actually justify, and it typically self-corrects 2 years later once fresher tax data is on file. The same SSA 4.4 form covered earlier explicitly includes the death of a spouse as a qualifying life-changing event, and it can be filed again specifically because filing status changed, not just because income changed. If someone you know lost a spouse recently, checking whether this recalculation ever happened is a reasonable thing to look into. Undoing a Social Security claim. If someone filed for Social Security within the past 12 months and wants to undo it because they claimed earlier than they meant to, or the benefit amount wasn't what they expected, there's a form called SSA 521 that allows a full withdrawal of the application. Benefits already received get repaid without interest, and the benefit then resumes growing as if the original filing never happened. Current SSA policy allows this only once per lifetime, and only within that 12-month window, so it isn't something to use casually. That's a lot of ground. Property tax layers, the new federal senior deduction, Social Security's tax thresholds, Medicare Savings Programs, Lifeline and LIHEAP, home sale exclusions, capital gains thresholds, RMDs, QCDs, survivor benefits, and the two situations that trip people up the most, the widow's Medicare gap and the one-time Social Security do-over. None of these activate automatically. The common thread through every single one is that some agency, county office, or form is sitting there waiting for someone to ask the right question. And the rules, income limits, and exact dollar figures shift by state and by year, so confirming your own situation with the relevant office or a licensed professional is the way to actually use any of this. Quick disclaimer before you go, this video is for general, informational, and educational purposes only. It was produced using an AI-generated avatar and AI-assisted research, and it does not constitute financial, tax, or legal advice. Program rules, income limits, and dollar amounts vary by state and change over time, and some figures referenced here reflect current 2026 guidelines that are themselves subject to revision. Before acting on anything in this video, please consult a licensed financial advisor, tax professional, or the relevant government agency directly for guidance specific to your situation. If any of this applied to you, the next step isn't complicated. It's a phone call to your county assessor, your state SHIP office, or your tax preparer. If this video helped clear something up, consider sharing it with someone else who might be turning 65 soon. And if you want more breakdowns like this one, subscribe for what's coming next.